right, welcome back to NADLN Forum Podcast Daily. I'm Ruby and I've got Lior here with me. So Lior, let's just get right into it. We've been watching the numbers and it looks like core inflation stayed put at 2.9% in August. That's basically right where everyone expected, which, I'm not going to lie, almost feels a little boring, but kind of in a good way, considering everything is chaos lately.
Yeah, Ruby, exactly. We always look for drama in these numbers, and sometimes it's just steady. The PCE price index, that's what the Fed likes, right? It's their favorite. And core inflation. So, that number without food and energy, because those are all over the place, came in at 2.9%. Still above the Fed's long-term target of 2%, but within the range. No panic buttons pushed at the Fed this week.
Yeah, but headline inflation, so that's with food, energy and all the fun stuff, was up just a tad, 2.7% year on year. Those stubborn categories, huh? Food, energy and housing keep inflating that headline number upwards. And, it's funny, when I first moved to Sydney, I actually tried to figure out my personal inflation rate while looking for flats. I was obsessively comparing how much takeaway coffee went up versus rent. Utterly scientific, right?
I mean, it's not that off, Ruby. That's what people feel day to day. Sometimes these indexes sound very technical, but for anyone actually house hunting or, even just getting groceries, it's those items, the ones you can't avoid, that make it feel like inflation is higher than what any official index says.
Exactly. It's like, oh, great, prices aren't rising much this month. Meanwhile, my rent just ticked up again and there's an extra 70 cents on a sandwich. Headline versus core. Totally different vibes when you're living it.
Yeah, and that's why everyone's always frustrated when the Fed says inflation is in control. But if your rent's shot up or you're filling up with gas twice a week, it doesn't feel so stable. But these are the sectors making all the noise, which is why the central bank looks at core to cut through some of that volatility. Less drama maybe, more real insight if you ask them.
So this sort of segues nicely, see what I did there, into the whole Fed decision thing. They didn't move rates again after that little cut last week, just kept things steady. I guess the game plan is wait and watch now, right?
Definitely. The Fed's playing it cautious. They already cut by a quarter point last week. Now they're watching if inflation comes down a bit more. And the PCE, it's their go-to because it actually adjusts for how people spend money. It's more accurate for policy. A lot of people think about CPI because that's what you hear about in the news. But CPI doesn't always catch the shifts in consumer behavior the way PCE does.
Yeah, that broad perspective can make a big difference, like when avocado toast suddenly drops off the brunch menu, Bad analogy, but it's about real spending patterns, right? So the Fed sees this stable but not scary inflation data and decides maybe they'll go for, 2 more rate cuts this year.
That's the expectation. Yeah. They want to help keep the economy moving, especially with inflation not going crazy. And I gotta tell you, I was tracking the market reactions here from New York. As soon as the Fed says no big surprises, we're holding. You get this immediate feedback. Stock futures jump, bond yields move, and you can almost feel the real estate investors breathing a sigh of relief. It's a very tight feedback loop these days, especially after last year's roller coaster.
Yeah, and the other thing, like building on stuff from a few episodes back, we've talked about how much timing matters for buyers and sellers. When rates change, there's all that scrambling. But with this holding pattern, people can just pause and strategize a bit. No rush to lock something in before rates leap again.
Exactly. Real estate loves stability, even if it's boring. Policy uncertainty, that's the real killer for planning. So steady inflation plus a patient Fed, that's as good as it gets for people trying to decide on their next buy or refinance move.
Which brings us to how people are actually spending. Despite everything, higher rents, tariffs, all that, American consumers are still going for it. There's this term, revenge spending, I keep hearing. Like folks were holding back during the unsure times and now they're making up for lost time, splurging on, big TVs or holidays. And, savings rates actually ticked up a bit to 4.6%, which surprised me. Usually higher costs mean savings tank, right?
You'd think so. But that's the resilience. The income went up 0.4% last month, and spending grew even faster at 0.6%. People are spending, but they're also stuffing away some cash on the side. That's a shift from previous cycles. And about those tariffs, everyone was worried they'd send prices through the roof, but what we're seeing in the data is much milder. Goods prices went up just 0.1% last month, services 0.3%. Companies seem to be absorbing a lot of the impact instead of just passing it straight to the consumer.
Yeah, that surprised a lot of people, right? Even Jerome Powell said tariffs are more like a one-off bump than a long-term inflation monster. I mean, costs for stuff do go up, but unless you're constantly tweaking tariffs, it's not going to keep driving up prices forever. And if we look at something like housing, which is always a hot button topic here, prices climbed just 0.4% last month. Still hurts for renters and buyers, but not crazy. And like we talked about in episode 10, housing trends make a huge difference in how people actually experience inflation.
That's a good point. Housing really drives affordability. Even if overall inflation is 2.9%, if your housing costs are going up faster, it feels way worse. For listeners, that means watch those specific categories: housing, energy, food, because that's where you'll notice the difference in your wallet, no matter what the official numbers say.
Totally. And as we look ahead, it's just about being tuned in, watching for big driver categories, staying flexible if rates do drop, and not panicking if those headline numbers jump around a bit. We'll keep tracking all the twists and turns for you and break them down every episode. Promise. Leo, anything to add before we sign off?
Nah, just that as always, stay alert, keep educating yourself, and don't get thrown off course by one headline or one data point. Thanks for tuning in. Until next time, everybody.
Yeah, thanks for sticking with us. We'll be back soon with more real estate and market shenanigans. Cheers, Leo.
Thanks, Ruby. Take care and see you next time.